Hello and welcome to this four-part series, The Self-Employed Debate in Conversation with Together. I'm Samantha Partington, freelance journalist for Mortgage Solutions, and today I'm joined by two of Together's most experienced financial professionals, Maeve Ward, Head of Intermediary Sales, Personal Finance, and Nick Parker, Head of Networks and Clubs, and their guests, Paul Zammit, CEO of the Loans Engine, and Greg Cunnington, Head of Strategic Accounts at Legal & General. Drawing on some of the facts and figures from Together's recent residential property market report, the house price to earnings ratio is forecast to be 7.7 this year, while house prices are set to rise 17% by 2029. Borrowers are getting older and personal circumstances are much more diverse, which makes getting the right advice crucial. Against this backdrop, self-employed borrower numbers have continued to grow. So to kick off our deep dive into the self-employed sector, in part one of our series, we're taking a look at the self-employed landscape and the opportunities and challenges in 2025. So Maeve, I thought I'd come to you first. Could you give us some sense of how big the self-employed borrower market is as we head into 2025? And do we expect further growth in this demographic?
Of course. Good morning, everybody. I think it's fair to say that the self-employed mortgage market has continued to grow, probably accelerated following the pandemic, mainly driven with regards to borrowers' circumstances and behaviours changing. So it's pretty commonly known out in the marketplace now that more often than not, borrowers will have a sideline, a separate gig, some form of self-employed. The reason that they've done that is purely because we're amidst, obviously, the cost of living crisis. So it helps with affordability. Alongside that, though, you've got the changing behaviours of borrowers and their needs. Some borrowers are looking for more work-life balance. And again, through the pandemic, you saw a lot of customers' circumstances change through no desire of their own, but actually with any change comes opportunity. Some borrowers who have gone into self-employed absolutely love being their own boss. They get to choose who they work with. They get to choose the environment they are and the hours. So when I read the residential market report, it didn't surprise me that obviously the next 5 years is predicting further growth for self-employed. The figures are quite outstanding. If we look back to sort of 2023, I think the figure that was mentioned was that the market was around 20.9 billion. And what they're predicting is by 2029, that figure will have grown to 34.8 billion. So significant growth over the next 5 years. Now, we know that obviously borrowers are underserved, especially self-employed by the high street. So what this means for the specialist market is the opportunity for further growth.
Today's self-employed borrower has many faces. As Maeve just explained, how have the professions and income makeup of self-employed borrowers changed over, say, for example, the last 10 to 15 years?
Good morning, Sam, and hello, everybody. I think Maeve really sort of started to touch on some of these sort of key demographics. But I think self-employed saw numbers shrink immediately after COVID came in. I think it peaked at around 2019, about 5 million self-employed. It's evolved quite a bit since the sort of the pandemic came in, as you would expect. A number of factors have sort of fed into that post-pandemic world that we live in now: changes in lifestyle, cost of living crisis, and the growing spotlight as well on diversity, equity, inclusion, which have changed the dynamic as well. If we sort of offset some of the shrinkage that we saw post COVID, some of that growth has come from the UK gig economy. Through increased demand for things like couriers, drivers, freelancers. A third of young people aged between 18 and 34 returning to work post-pandemic did so in the gig economy. You've seen the rise of social media platforms such as TikTok, which has created a new breed of influencers who are making a growing contribution to the media freelancing sector. And according to a report by Standout CV, the UK gig economy workforce is estimated at around 1.7 million workers who contribute around about sort of like, I think Maeve said, about 20.7 billion to self-employed in total. But if you think about the UK economy, that's on par with the aerospace industry. I mean, it's absolutely huge. And interestingly, only around 20% of gig economy workers would class this work as their main income source. with 48% of gig workers also having a full-time job. So this is likely reflective of the increasing pressures of inflation, cost of living over the more recent years. You can also signpost to challenges for university and adult education, where costs have risen significantly to continue studies thanks to inflationary pressures, but the financial support that's been available to them has remained largely static. So this is contributing to growth in that gig economy area for students taking on more and more work, extra hours to manage the increased cost burden. So that puts them into that kind of self-employed and gig economy category.
Just focusing then on what you said about the sort of the significant rise in gig economy, self-employed workers. What's, specific challenges does that pose when trying to get a mortgage? I'm thinking in terms of like, evidence of income, and is it something that scares lenders? It's very flexible working, isn't it?
It is absolutely flexible working. There's a lot of unknown factors within the gig economy, especially when you think about a lot of them are on 0 hours. Those kind of things, the earnings can fluctuate quite frequently. The fact that they may sort of dip in and dip out as seasonality, as demand grows and shrinks. And it's very, very difficult for high street lenders that rely on algorithms, rely on a series of rules to be able to apply those rules successfully to that type of economy and work out, whether or not there is a propensity to default or whether what they're doing has any long-term sustainability.
Paul, how would you describe some of the typical attributes of a self-employed case that lands on the desk of a packager like yourselves, because it falls outside the high street's lending appetite?
Yeah. Hi, Sam. Good morning, everyone else. I think it's funny, actually. Nick just mentioned there around the sort of the appetite for the high street. I mean, I'm not going to name any names, but one of the top 6 is potentially looking to exit the market. Is that really a result of the specialist market potentially growing 70% in the next few years? Who knows? Obviously, self-employed making a large chunk of that. I think in terms of attributes, if we roll back, probably pre-credit crunch, around the sort of 2006-7 era, if you were self-employed, typically you're either limited company or a sole trader. There wasn't really much in between. I think the gig economy definitely has made a difference in terms of the percentage of self-employed borrowers, but I also think that if you think about direct contractors, umbrella companies, IR35, all those demographics fit into a pool of clients that the high street, when they look at it on face value, looking at algorithms and so forth, just get a bit nervous. It's one of them scenarios where typically we see at the loans engine where a broker will reach out to us and they say, I can't name any names, I've tried X, I've tried Y. They just can't get comfortable with the deal, whether it's for additional funding, because of course we're talking, I guess, a lot about the purchase market here, but what we see at the loans engine is more a capital advance decline. And I guess when you look at it on face value, having been in the specialist industry for 21 years now, for me, what we would class as a non-standard application, actually a lot of the time is a standard application on the basis that the lenders that we're working with, mainly together, to name one, of course, for them, they're looking at it from a holistic point of view. It's not just, focusing just on the income. They'll be looking at the client's profile from a point of view of credit history, equity, of course, a big factor when it comes to risk appetite, general lifestyle, etc., on an affordability basis. So income is just one part of that jigsaw.
Greg, are more self-employed borrowers finding themselves falling into the specialist bracket? And if so, why do you think that might be?
Yeah. Hi, Sam. Morning, everyone. Really good question. And I think the answer is kind of an evolution of a lot of the points that kind of I heard Maeve and Nick make, which is, if you look at it, I think more self-employed borrowers do fall into the specialist category, but I don't think it's necessarily lender appetites changing. I think if you look back at the top 6 lenders, for example, they've always had self-employed criteria and accepted your kind of vanilla profile. I think it's the complexity of the client scenarios which are now hitting the desk, and the ones that actually we would look at and say, this isn't actually that complex. It's a pretty, straightforward gig economy kind of case, 2 jobs, as Nick has just mentioned. If it was your own money, you'd lend it all day long, but it just doesn't fit that kind of algorithm risk-based lending that sat there. And we've definitely seen a rise in it post-COVID. I think that was a big change. I'm obviously currently at Legal and General Mortgage Services, so we've got insights to a humongous amount of data, but my background was 18 years mortgage intermediary before then. And even anecdotally, I remember if I go back to my kind of earlier years advising, you would quite often do 3 cases a week, which were 3 times income, 25% deposit, and off you go. They didn't exist towards the end. Every single case was needing to push the income profile or had 2 jobs or an element of self-employment. And it's just become part and parcel of kind of people's remuneration and how things work. And the complexity isn't even just self-employed. You've got things like vested stock and bonus and what have you. It's just getting more and more specialist.
Okay, so Maeve, to end on a positive, we've already talked about the challenges that self-employed borrowers with complex circumstances face. But what makes this market an exciting and opportunistic one for brokers and lenders?
Good question. I think it's fair to say that whenever the market goes through some economic turmoil, the specialist lending space in particular is very resilient. And I think over the years, it has really shown itself to stand the test of time. Obviously, as the high street tightens, and if we're looking at self-employed as an example, that generally will be the first nod. So they will have a look at what they perceive to be more riskier borrowing, and they will then look to tighten that up. I suppose when that happens, it opens up opportunities for alternative lending solutions. And that's probably the biggest opportunity that brokers are facing right now in terms of diversifying their product portfolio to best serve their clients for cases that perhaps once they could get through, that they are finding harder or not able to place at all. And that's a real play for collaboration. And that's collaboration between lenders, networks, mortgage clubs, the specialist packager. Greg touched on Ignite at Legal in General. And I think this is a real sea change. This is about spinning how you do your research on its head. It's about looking at what you're finding hard to place from a criteria perspective and going to the criteria source engines first.
Thanks, Maeve. That pretty much draws us to a close for today's session. I'd like to thank my guests, Maeve, Nick, Paul, and Greg, for that interesting insight into the self-employed market. And join us next time when we'll be shining a spotlight on specialist self-employed lending opportunities.